We're starting with session 5, price analysis and trend line analysis, but there are a few points I want to cover from yesterday. We referred to price line support and price line resistance based on close. I like to call it close line support, close line resistance. When we have price activity where yesterday's close is initially our support or resistance level. If today's low and close are both greater than yesterday's close, we can use that as a close line support level. Because yesterday's close is our last reference point going into today. So our last input for support or resistance is last night's close. If the market opens higher than last night's close and during the day does not go back below the close and closes up for the day, it's above that close line support level. We can extend a line on our charts, on the bar chart, at yesterday's close. And it will stay as support as long as we continue to close above that level. As long also as the low does not break it. If we start to rally the next day and stay up all day, even if we gap above yesterday's high, the high, low, and close are all still above last night's close. We will see attempts of the market to come back to that close line, but as long as the intraday low and close remain above the line we've drawn on the bar chart, that line should be considered the price line close support. If we break that line intraday, not necessarily close below it, we break the line and come back up and close above it, all's pretty much well and good, but since we have broken that line is still in there as a support level, but it doesn't carry the weight that it did initially, where each day's low and close were still greater than that close. Every time you can have a close where you can draw a price line or a close line support, gives you another input for support. But if you break the price support line, it's negated only in the sense that it doesn't carry, as I said, the strength that it did the first time. It's still a support level. If the following day, after a few days, we make a new close with a high that is below where our last close line resistance was. And close line resistance is where where today's activity, the high and the close, are below the close the day before. Now it becomes a close line resistance level because all price activity and close remained below the previous day's close, which sets a new resistance level at the point where the close was greater than the following day's high and close. We extend that line across the chart. So in this example, if we want to call it X point, we'll look at an X point where the close was made on day X. The following day, day 1, 2, 3, 4, and 5 days later, all those respective lows were still above where we drew the close line support. On day 6, intraday activity went below our close line support. So it no longer carried the weight and validity it did initially. On day 6, we went below that price line support and closed higher for the day. On day 7, our low, high, and close were all greater than the previous close, which was clothesline support again. The following day, we move up and down and close higher, but still above. On day 7, still above the close of day 6. On day 8, the high, low, and close are below the close price level at day 7. Now we've got a new point at which to draw a close line resistance line. The following day, we gap back up again or move higher again, where the low on day 9 is greater than the previous close on day 8, and close above the clothesline resistance that we had drawn from day 7. We're now back in possibly an up move. We don't know because we have to see what the next day's activity are. If the following day, the close is greater and the low is greater on day 10 than it was on day 9, we can draw another clothesline support level based on the activity of day 9 where it closed and the price activity on day 10. When you're marking these charts, you want to be able to look at what your last input was, which was your last data point for close, because that data point will give you the reference the following day after the activity of the following day. If you look strictly at a bar chart, and every time you have a close where the next day's trading was greater than both the next day's high, low, and close, all three were greater than that previous day's close, that's where you can draw your line. That's where you put your mark on your bar chart. Just take a red pen and mark a bar chart. Circle, put a dot where that close is, and watch the price activity. As long as it stays above all activity, high, low, and close are all above that point, it should be a key support level. The inverse, when you're looking at the close being your starting point to where your next day's activity, you're starting on day X again, we can call it, but we don't know what that value is until the following day's trading. We know where the close is. We can put a dot on the chart where the bar line or where the close line is. If the following day it opens lower, trades up, but never exceeds that close and closes down below that previous close, then we can draw our line for price line resistance on close. So in this example, where X is your starting point, day 1, all price activity, high, low, and close were below the closing level of X. On day 2, we open lower, trade lower, and close much lower. But we're now still also below the close of day 1. So we've got 2 important closes just above the market. And on our third day, we come back up and break the high made at 2 on day 2 and close above our clothesline resistance of day 1. But we're still below the clothesline resistance on our X day. So the closing price at X on our X day was still greater than the highs even on days 1, 2, and 3. Day 4, the market opens down, and by the end of the day, rallies up and closes above that clothesline resistance point of our X day. Now we've broken it and closed above it. But on day 5, we open higher, trade up all day, and our low equals the close price of day 4, and then turns around and closes higher than it was at day 4. So we can look at day 4 and draw a new clothesline support level because we've broken on the upside. We extend the line across. On day 6, market trades higher, a higher high, higher low than it was at day 6, with an equal close to day 5. We can't use day 5 as a clothesline support level because the low on day 6 was less than the previous day's close. But we are still using the line drawn on day 4's close. It's a very, very powerful, yet very, very simple way to look at price charts. If you had, in this case, the X day hold a support, then it was broken where it was on day 4 and it closed up, I still look at the X point as a long-term support level. Now, when you look at a price chart and you just put the easiest way to do it to where it stands out so much is to take a red pen and just put a dot on these closes. You'll see one at X, and then on the X day, we could use possibly the X, but we don't know it till the next day's trading. On day 1 on this chart, we have a new point, a new close for a clothesline resistance. Day 2 stayed below day 1 and also below our X day. On day 3, it starts to rally, breaks the price resistance on close at day 1, stays below the price close resistance of the X day. Day 4 breaks above clothesline resistance drawn on the X day. And day 4 also, we don't know until day 5. Day 4 becomes a new clothesline support level. These patterns are most helpful for seeing where price support is based on price alone. I spend a lot of time and put a lot of emphasis on closing prices. This is a way of not even looking at an RSI or a CFG chart or anything. This is a way of looking at straightforward price analysis, basic technical work, high, low, close, which should be your starting point on your price analysis. After a while, and at this level, after taking the courses, we put more emphasis on RSI and sometimes look at RSI charts and don't really even look at price charts. But straightforward price analysis on close, to me, is very important for 2 reasons. Number 1, that's where your account's balanced. That's what your position is worth. When you buy, you look at where the market closes. First thought, when it closes, where did it close in relation to where I either bought it or sold it today? Because that's your first input as to whether you're on the right side or not. In the case of our X day here, in this chart, and I've marked these clothesline charts, chart A and chart B. With the X day on chart B, if you had bought near the high, say you had bought at number 1 circled, and it closed below where you bought it that day, you're underwater. Your first thought is, I'm losing money. If you had bought it down near the low of that day, say at point 2 circled, and it closes up for the day, you're ready to leave the office and buy drinks for everybody. Where a market closes gives you input, not only of price and support, but also how well in tune you are with the trend and how well you're doing your analysis. Because we all want to buy low and sell high, and most people don't. So your close at the end of the day tells you, if you bought or sold, where you are in relation to that close, whether you're making money or losing money. Number two, most technical indicators are written for close price analysis based on close. 15-minute chart, 15-minute closes. Hourly chart, the close at the hour of trading. I think it's vitally more important where you get out than where you get in. You can get in and be wrong and still get out and make money or break even. So it is more important where you get out than where you get in. If you ever put a good trade on and it works, and then you get out way too early and you see it explode and take off to the upside, where you got out, you left a lot on the table. Close price analysis also is important because of the fact that not only is your account statement balanced on what the closing price is, but you have, during trading hours, people buying and selling, people from the night before who did their analysis and they're trying to determine whether they're going to buy today or wait until the following day. And as you get closer to the close, I find the last 45 minutes to an hour to be the most important time period of the day. The last hour, especially like the last 30 minutes, if I'm not in the market, I'm deciding whether I am going to buy it today or not. Am I going to buy? Am I going to get in today? Am I going to sell today? Or am I going to wait and get my next input, next data input with the close today? Those that are holding positions in the market decide sometimes a little late in the day, am I going to hold this overnight? Am I making money on the trade? Probably either going to take a profit or hold it. We talked about earlier the 4 decisions: buy, sell, hold, do nothing. And a decision to do nothing is a trading decision. You have chosen not to participate at this point and look for more input before you make your next trading decision. But those that are in the market decide whether they're going to hold or whether they're going to dump it by the end of the close. So the closing price actually gives you a balance of the buyers and sellers, but also an indication of which way it's moving. You could say at point 1, or let's look at the X point on this chart B. You could say that the previous day, we closed, since in reference to before X, it closed up for the day. There was a gain for the day. Those who are long are going to decide whether or not to hold or take profits on day 1. The market opened lower and turned down. Could have been people taking profits on long positions and selling out. You can look at volume on these days and see how volume goes in concert with price activity, but we're not going to cover that in this section. What's important to note is, since the closing price is basically the culmination of trading activity, traders' opinions of future direction of activity, and the balance of your account statement, it carries a lot of weight. When I started working with the RSI 15, 20 years ago, that's the first thing I started to realize is this close is more important than the high or the low. When we get into the pivot points in this section, some people refer to them as swing points. Some people refer to them as pivot points. But what you will see in the formula, it's high plus low plus 2 times close. We're double weighting the closing price value, then dividing it by 4. But in these examples here of close line, chart A, chart B, you will see how price action moves, especially on close, and how you can draw trend lines based on that support and resistance. And just to finish up on this chart B, when you look at the closes, if you were to not only put a dot on that close, but if you were to tell the computer right in your computer. Give me a line on close, where you tell it that basically you're doing a 1 period moving average. You're averaging the closeout for one day to the next. If you were to look at a line on close, the line on close would look a little different than the bar chart. The line on close below here on chart B, you'd be up, then down on day 1, down a little more on day 2, up on day 3, up on day 4, up on day 5, and then flat on day 6. Looking at just the line on close, you see something a little different than you see in looking at a straight bar chart over 4 or 5 days. The line on close reduces the noise, takes out the volatility of highs and lows. Highs and lows are still important, but the direction of closes. Think about it. When you put a moving average on a chart, 9-day, 10-day moving average, you want to see price activity continue to close above the moving average. In these charts with clothesline support and resistance, you want to see the activity stay in the direction in one way or the other. And when you plot your price, when you put the dot on close, you will not know if today's activity is going to be greater than or less than yesterday's close until you have that activity. But to finish one last point on this, as long as you're seeing the clothesline supports hold, it's more of a short-term analysis, but you can use it on long-term analysis. If say on day 7, today's high equals yesterday's close, and then closes well down on the day, below the closes at day 6, day 5, day 4, and day 3. Now we've got a new clothesline resistance on day 6 based on that close of day 6. The following day, the activity opens and trades up, then comes back down on day 8, closes about unchanged, and the next day drops even lower on day 9 and closes down at the bottom of its range, well, where the high on day 9 and close are both less than the previous day's close on day 8. We now have a new clothesline resistance level. If the moving averages had turned down on price and RSI, if the range had shifted to where the RSI was still below 60, say, on days 5 and 6, you might have a range shift taking place to the downside. The moving averages have turned down, the 9 and 45 on RSI, and maybe the 9 and 45 on close. So the clothesline resistance on day 6, you might be able to extend that all the way across your chart. And it will serve as resistance and give you direction of trend until the trend has indeed taken out the clothesline resistance based at points 5 and 6, especially point 6. Because on day 6, the high, low were both greater than the close on day 5. But the closing price on day 6 became our new clothesline resistance because the high on 7 and close were not greater than the closing price at 6. These charts are very helpful, especially when you see the patterns we talked about earlier, the signal counts. If you saw a bearish divergence and then saw the market sell off where the close became a clothesline support that you could draw the following day, because the following day, high, low, and close were greater than that previous day where the positive showed up, extended across the chart. So that each day that you close above that says the positive reversal that we're seeing evident here is being confirmed by clothesline support continuing to hold. And we're making higher highs, creating bearish divergence, higher closes, and we're continuing to stay above that positive reversal point, which is also a clothesline support point. If you saw a bullish divergence that kept rallying into negatives, you could draw your clothesline resistance at your closing price level that show as clothesline resistance. And until they're broken on the upside, they're still valid. The trend is still down, even though you're seeing lower lows and lower highs, which is telling you anyway that you're in a basic downtrend. So we tried to explain this yesterday with those two patterns, the complex bullish divergence with negative showing, the complex bear divergence with positive showing. And this price analysis is something that you can you pull it up on the computer. If you see a bearish divergence, it looks like positives, look at this last 10 days up to that point or 5 days. It doesn't matter because your last input is the previous day's close in relation to today's activity. As far as using it on support and resistance, if you see a clothesline support level to where you can draw that line across the chart, you take a trade to the long side if you're buying, and we'll get into pivots as far as increasing the or tightening up the range in which you consider it a window. Because I referred on my updates to buy signal windows or sell signal windows, a window of price that I've done the work on that I expect the markets to reverse from. If it was a positive reversal, I'd say we need to sell off a little bit more to our window, which is on, say, silver, 450 to 440, 450 to 445. That's a 5-cent window I'm going to be looking at. These price line support and price line resistance levels will give you good indication for stop losses. Putting your stop if you're buying below a previous support level based on a previous close support line. And when we get into pivots, we'll be able to also combine them with pivot point analysis. In the case here on chart B, day 6, where we drew the clothesline resistance, which was the new one, still held on day 7, day 8, and day 9. The close at 0.6 on day 6 is your close, is your resistance on close. It should not close above that if all your other indication is it's turning down. So if you're short anywhere near there, you want to have the stop at least at there, if not the high of that day. And we'll see it when we get into pivot points, when if you take and approach markets with this clothesline support and clothesline resistance and combine it with pivot points, it's short term, it's pretty short term analysis. But I can see these, and you will see them too if you check hourly charts, daily charts. If today's high, or excuse me, if today's high is greater than last night's close, today's high, low, and close are all greater than last night's close, we've got a point at which we can consider as a clothesline support level. If tomorrow we look at even drop to an hourly chart and the market opens up and during the day, you can see it on the hourly charts if you're doing hourly charts, where your price line support and price line resistance should be. So you start with the daily and then narrow it down to an hourly. I was talking to someone about the entry points using these. And I said, well, first of all, if I know I've got a positive based on last night's close, say a 4-period positive, my worst entry tomorrow should be tonight's close, because tonight's close tells me it's a positive. It tells me you have the potential for a positive reversal tomorrow and a reversal in the market back in the direction of what looks to be the uptrend. My worst entry should be close or better. We're going to use pivot points to identify price ranges for support and resistance the next day. But what do I want to see tomorrow based on what I saw on last night's close? I want to see the market close up. So I already have my reference point. Last night's close, say we're talking silver again or gold. Gold's a good example. Last Friday, gold had a clothesline support level of 290.10. This past Friday, it closed at 297. The low for the week was still above last week's low on a price line support basis at 290.10. We never violated last Friday's close. Trend is still up. Coming into this week, where it closed at 290.10, you couldn't get closer better because it never went below last Friday's close. And you say, oh, hell, I missed the trade. Think about what that told you. 290.10 is support. It didn't even violate it on a price basis. And all the activity for the week, high, low, and close, were all greater than the previous Friday's price line support level. So when you can get a line on your daily chart at say it was at 290.10, it holds all week. All the activity is above last week's close. That's a market with a very strong bias to the upside. If last week's close was 290.10 on a Friday, and all the activity for the week was all the week's activity, high, low, close, every single day, was below 290.10, then that serves as a major or significant resistance level. You will learn how to do these by looking at bar chart after bar chart. Every time you see, in our first chart, we'll call chart A. In our first chart, we had our X day, which served as price line support. Market stayed up, and it violated that price line support on day 6. But on day 7, we were back above it versus a close on 6 with our activity on 7. On 8, we come down close to it. Say we didn't violate it. Point at X was a clothesline support level to start. Day 1 on chart A, day 1 stayed above it, day 2 stayed above it, day 3 stayed above it, day 4 stayed above it. But on day 5, even though we stayed above the price line support based on the X day with the line drawn across, on day 5, we had an up close. On day 6, we had a down close. So you can actually put a dot right where day 5 is. So basically, the way on chart A, you're looking at X through 6 now. You had a clothesline support based on the X day. And then on day 5, you had a resistance line drawn. Day 6, it fell below it, but closed back above the line based on the X day. So you've got a couple dots in a row. But you don't know what's going to happen until the following day's activity or the following period. This could be an hourly chart. It could even be a 15-minute chart. I'll give you an example of it. When you can connect the closes like we did, we're talking about line on close, you'll see something in the chart line, but you're only looking at a list of closing prices. You will see more of this activities back and forth, where you'll be able to put a dot on the bar chart where it was a resistance line close. Maybe 2 days later, a price support line close. Then back and forth. When the market gets choppy, it'll do it. But if you're at key turning points in the market, you should be able to put that dot where that close bar is, where it closes, and put the dots on the chart, and then all of a sudden the market takes off and it never comes back down to that level. If you think about positive reversals, you're going to make a lower close in RSI, but the price is going to be greater. If the following day the market does jump up, it stayed above that price line support level. Draw that line across your chart. It might be a week later, You've had a couple dots to the upside and downside. You've marked all these, and all of a sudden there's a sell-off, but it only comes down halfway from the first close where you drew your price line support, your rally up, and then it sells off 50% retracement and has another upline close support line you can draw where the following day's activity is greater than the previous close. Now you're going to do that stair step to where you're drawing lines across the chart. Each day that you look at a trade or a bar, you have to look at it individually. Remember we talked about that early in this session, in the edge. It's a moment in time. But that moment in time gives you input. Simple, basic price analysis input, which is telling you the perception of traders. And every day that you have that close show up, it gives you some homework to do, actually. You say, okay, the market closed here. Now, tomorrow I have to see, does it stay above that close? Is tomorrow's low greater than last night's close? Is the high greater? Is the close greater? Once you have that input, you can draw the line. But you could have input in this example to where on chart A, day 5 has a close line resistance line drawn based on the data input from day 6. On day 6, we look at the data we have from day 7 and say, well, on day 5, we had a price line resistance line to draw and close. On day 6, it turned out with the data on day 7 that day 6 had a price support close. So you had one day you had a resistance line that you could draw. The next day you had a support line to draw. And you can continue to draw, you can continue to get these, what I call them dots, or because when you look at a bar chart, just put a dot where it is. You got a black and white printout of a chart, put a red dot on every close and see the price action the following day. And it can go back and forth. It can chop around. It's constantly changing. There should always be one line that'll be a key line. Markets are constantly in transition because people's emotions are constantly in turmoil. Am I making money, losing money? Did I have an accident last night? You know, am I worried about my car? And then I come to work and I'm trying to trade and I've got the insurance company calling, I got the body shop calling. But this price line analysis with close support and resistance, every time you see one, it'll be back and forth. And the ones that hold the longest time, if you go down, if the bar chart goes down, the market sells off, and it makes a bar close to where the next day's activity says the previous day is a clothesline support level. Then it rallies for 2 weeks and never goes back down below that. But you're going to have up days and down days in between there. But when say it rallies and then, as I said before, corrects 50%, and you've got these lines drawn on your bar chart, it may come down and violate one, then rally, then set a new resistance line, not be able to get above it, go down again. You went from a price support line to a price resistance line. As you work down the chart, you have one from a week ago, one from 2 or 3 weeks ago that are still holding on a daily chart. The Dow Jones, when it sold off after September 11, created one down at the bottom of the chart that's still in effect at 8,200. The most recent ones I saw in gold were to the upside. The longer term ones were to the upside. You've got a price resistance line coming across in the gold market basis April at about 302. When that is broken, we'll probably see 310, 315, 320. And somebody says, you're saying that we're going to an inflationary cycle. I said, wait a minute, let me take my trader hat off, put my economist hat on and answer that question. But I understand the economy and forecast my outlook for the economy based not on economics and fundamentals, based on charts. And all I know is this last go-round that we've had in gold and silver, we've been turning bullish on it. The price line, support lines are showing it. they're showing support on the gold, 290.10. That's your support right now. Somebody says, where's gold support? 290.10. Where's resistance? 302 and a half, I think it is. It was a clothesline resistance point because it had gotten up there, closed there, and the next day's activity was below. High, low, and close were all below it. So you've got a price line resistance coming across at 302. You've got a price line support coming across at 290.10. You've got a $12 range in there. People talk about buying breakouts or selling breakouts to the downside. This is a way that'll help you see markets better, and you'll be able to see where your support and resistance is. Those 2 points are also key too, because on my RSI charts, they're going to tell me something. Where are those clothesline resistance levels in relation to what the RSI values were at those specific points? Since 302 was a new high for the move up in gold, 290 was the support level where we had our last positive resistance support or positive clothesline support. We know that the boundaries of this range. And to confuse everybody, they closed it for the week about in the middle of the range. So we want to see, first off, what next week's price activity looks like. It could sell off to 291. If you think about it, if gold closed at 297.5, our last input is the most recent close there, gold could sell all the way down to 291. And how many people would turn bearish seeing it go from 297 to 291? Most people say, well, it's moving down, so it's got to be a sell. If it does not break 290.10 and we get another positive at 292 or 293, it's going to be off to the races. And if you get a positive above your long-term positive reversal support line at 290, it will tell you that the market is indeed in an uptrend, number one. Number two, if you have a positive, we already know the range rules are positive, that the next positive reversal should set an objective where that positive, the amount of the positive has got to be added to your highest close, which is 302. So if you have a positive reversal showing and say, we're going to close above, we should close above that positive reversal support line. If the low coming into this next week is 295, and that turns out to be a $5 positive, we're going to tack that onto the 302, set an objective of 307, and probably draw another positive reversal support line at around 295. They're very helpful not only for placing stops and support and resistance, but they're also helpful for just being able to eyeball a chart and see what your price activity is in relation to momentum, where the RSI closes are, and also a long-term analysis on a weekly chart to give you a perspective of the long-term up-down. And you could get where markets get chop and slop, as we like to call them. It's chaos and confusion, maybe for 5 days, up, down, up, down, up, down. You're getting positive reversal support lines, positive reversal resistance lines, back to breaking that support line, setting a new one, then down day, and then up. When markets get like that, they're getting crazy. It's not straight up, straight down. If it were straight up, straight down, I wouldn't be sitting here teaching. But the beauty of them is the fact that they're focused, they help you to focus on, well, it appears initially going through 10 closes here, short-term analysis. This type of analysis is straightforward, it's simple, it's objective. You don't have to question, what's the last input I have? If you look at it on a weekly chart, it gives you a longer-term perspective. You can look at these charts on 15-minute, 5-minute charts. I've shown 5-minute traders how to use them. So being able to take something as simple and straightforward as standard price analysis and be able to look at it just on a bar chart and get an idea of trend, an idea of support and resistance. Give me a time. And with the trend analysis perspective, that's what we're here for. I mean, I talk about you can trade and you can make money. There's a big difference. This is one of the things, it looks like a short-term trading approach, but it can be a long-term input and really dynamic for position trading, for trend, and identifying the bigger moves, which is what we're here for. We're not here to just scalp it. I mean, I can use it on a 3-minute chart and scalp all day long, but I don't feel like sitting in front of a damn computer all day. I've got more to do, and I've got things that I want to do where I'm not going to be chained to a computer. But it's a great input with positives and negatives for support and resistance, for identifying where you should go on a short-term basis as well as a long-term basis. The price line support levels that you get based on close only give you an indication of both short-term and longer-term support levels or levels of support and resistance. Another way of doing it that I like to use is what's called the pivot points. Some people call them swing points. I refer to them as a pivot point. It's basic price analysis, again, because you're only looking at price. You may hear or may have heard already of floor traders using little swing points and price and resistance on 1-minute and 3-minute charts. Some of them referred to as price analysis swing or swing points. It's simple, straightforward analysis like the price line on close is for support and resistance. With pivot points, what we're looking at are the high, low, and close for the day. Similar to what we saw on the price support lines and the price resistance lines. The only thing is with the price lines that we were drawing based on close for price line support and price line resistance, there was no weighting of the close. In session 5, you see we have trend line analysis and all the different ways you can draw trend lines. Simple bar charts, close only, bullish divergence trend lines, to where if you think you have a bullish divergence, you draw a line similar to what you see on price line on close. Take that close mark, draw a horizontal line, and you'll see it break it because bullish divergence comes in downtrends. It'll rally a little bit, but that'll be a support line and it'll be broken. Bearish divergence trend lines drawn the same way. Bear divergence resistance lines, bull divergence support lines, positive reversal support lines on your close chart. When you see a positive reversal and you can draw a price line on close as support horizontally across there, if it's a strong positive, it'll hold it. Negative reversal resistance lines there, 0.8, 0.9, positive reversal trend lines. If you look at a bar chart, see a positive on your RSI and go back to where that positive was before, you can draw lines horizontally on the chart at those price closes or connect the closes. Forget the intraday high lows. Just connect the closes with a line and draw it like a trend line because a positive reversal should be higher than the close was as your reference point that you're using for the positive. And go back a week, 2 weeks, 3 weeks, depending how many positives you've seen. Take your lowest point on the chart and draw through that positive reversal that just showed up. It gives you a good long-term uptrend line. For negative reversals, do the same thing. Connect your negative reversal points. The points 11, overbought, oversold support lines, you can use those at the last high or the last low on a price bar basis, where you either had a bullish divergence, the market is short-term oversold. Bearish divergence, short-term overbought. Go to the high in that pattern that you see the divergence. Draw a resistance line horizontally at what the high is. For a bullish divergence, draw it at what the low prices were intraday. And point 12, triangles, wedges, channels, they're all the different patterns that you can draw on a bar chart, or not a bar chart, but an RSI chart. You'll see wedges in RSI. You'll see triangles based on the patterns you're seeing. But base your points to draw the lines on key RSI points. Positive reversals connecting them, negative reversals connecting them, close only lines. There's all kinds of lines, but this line on close that we went over before is simple and straightforward. In concert with the price line on support on close and price line as resistance on close, we have what's on the next page, the pivot points. The formulas are there with the pivot point high plus low plus 2 times close, because you're waiting the close. Then you take 2 times the pivot point minus today's low to project what the next pivot point should be on the upside, or your pivot high. Below that, 2 times the pivot point minus today's high equals the next pivot low. Simple, straightforward. It's more weighted towards the closing price value this way. Your next support and resistance through range, if you take the high minus the low for the day, for the hour, for the period, say it's 15 minutes, and take the range plus the close of that period, it will give you what should be your upper pivot for your next trading period. If you take the close minus the range, it will give you what should be your lower pivot for the next day's trading, or next period if you're trading an hourly, for the next hour. So you're looking at the period that you just completed for your pivot points, taking the high, low, 2 times the close of that divided by 4 to get your pivot point. Then you're going to do 2 times that pivot point minus the low to get your next pivot high, and 2 times the pivot minus the high to get your next pivot low. At the close of the period, if it's a day or an hour, you do this analysis or run it in your math models to get a projection for your next period of trading. It's strictly price analysis. The next resistance and support, as we have there through range, you follow with range plus close, range minus close to get your upper pivot and your lower pivot. So you've got 5 points. If you look at the bottom, you've got 5 points where you're projecting the ranges for support and resistance for the next day, week, or the next period of trading, where you have a pivot point, midpoint, or swing point in the center. Above that, a pivot high, and above that, an upper pivot. On the downside, below your pivot point, you have a pivot low and a lower pivot. So you have 5 price levels in your next time period of trading. You should have an indication of what the price should do in reference to those points based on price alone. If you take these points and look at them with what we did with price lines as support on close and price line closes as resistance, you get a number of points where it can bang around during the day and have an idea whether or not it's breaking that close line. These points are very, very helpful if you close the period and think you have a positive for the next day's trading. You run your pivot points and your high-low range chart, or high-low range, to find out what your upper pivots, pivot points, and lower pivots are going to be. You know before the next trading period where those numbers are in relation to where we just closed. If you see what you think is a positive and you want to buy, you should buy close or better. Whatever that close should be your worst entry, because you expected to see it turn up from that level. So you start looking at the pivot low and the lower pivot to start getting an idea of where you want to buy it. If you take that in conjunction with what we did with the price line on close on your daily chart, maybe going into, like we had talked earlier about gold, where it had a pivot, it had a price close of 290.10 last week, which served as a close line support all this past week. Now going into next week, you can do this on a weekly basis too, to get projected ranges for your weekly chart. And look at those weekly projections for pivots on a daily basis. Here's my weekly pivot high, here's my weekly pivot low. And the trading during this week stayed above my pivot low. So it's very, very helpful in conjunction with positives, looking at the pivot low and the lower pivot, and with the negatives that show up, the pivot high and the upper pivot. And used also, as I said before, in concert with your line on close support or your line on close resistance. The chart after the formula page is a June crude. Then I marked PHPL. What I did is I put a bar chart on there and put a line on connecting all the pivot highs and also all the pivot lows. You can see how it's like a set of trading bands around it. The chart after that is the same chart, just a close-up on it, where it says PP in top, PH, and PL. That's just a line connecting all the pivot points, a line connecting all the pivot highs, and a line connecting all the pivot lows. Now, one thing you will notice, coming out of the February low in early February, how tight the pivot point was to the pivot low during the first part of February, and how much further, when it started up, the pivot high got above the pivot point into early February and mid-February. Then as price action started up the line going into March, it got pretty narrow again in late February going into March, and then it seemed to expand to the upside. So when we talked about trading bands, Bollinger Bands, Keltner Bands, Stark Bands, these are almost, in a sense, self-adjusting because they're adjusting with price alone. And if you look at it this way with the price, with a line on the pivot point, a line on the pivot high, and a line on the pivot low, at important turns, you will see them almost contract. Because before a market goes higher, it tends to close at the low end of its trading range. When a market has been up for a while and is up near its highs, it tends to close before it reverses near the upper half of the range. Because the market will look most bullish at the top and it will look most bearish at the bottom. Your next one is just another one where I had put it, and this one was on bonds. I didn't write the number or market name on there, but the scaling showed it was bonds. And in early March, when bonds started to sell off hard, you see how much that contracted as prices went down. Your next chart, June crude, we had talked about February, in that February time frame where it was starting to contract and yet looked like it was ready for a trend change. Your middle chart has the pivot high against a nine period moving average. The bottom chart has the pivot high against the 45 period moving average. So when you see, what I like is the longer term chart. So look at the bottom chart, the pivot high against the exponential 45 on close. In January, it's below it. It almost looks like a RSI line. But in late January, it crossed above its 45 moving average, came back, tested it in late February, and took off to the races. You had a rising bottom formation in your RSI chart. You had hidden signals, and you had a range shift with your moving averages on RSI and close all turning positive in mid to late February. And with this analysis and looking at the bar chart on the top, using your close line support levels where you see the close showing that hash mark to where you could draw a line horizontally support and see it take off and move to the highs, then turn up. So I put a couple other examples in there with the dollar and the CRB index. And if you look at the bottom, the CRB index is not one of the pivot high closes. It's a short-term tool that I use where I'm putting an exponential 5 on RSI, then an exponential 3 period on that 5 period, and then a 9 period on the exponential 3. And it gives you an idea how you can use moving averages on a real short-term basis on RSI. But it works very well if you study it in conjunction with the pivot points. But I gave you a couple other examples in there of that So you'll have an idea of how you can use the two together. But this is just something with the pivot point formulas. If you use them with the line on close in conjunction with positives and negatives, it'll help your trading. And it'll also give you an idea where to put stops.